All right, good afternoon and welcome to the Boring Millionaire podcast. My name is James Lamantia, and my mission is to not only make you money in the stock market, but to educate you and make you feel confident in doing so yourself. So today is Saturday, March 15th, but this episode I'm going to recap the past 2 weeks of trading that we've seen in the stock market. So the S&P 500 and the NASDAQ had both been falling a little bit sharply, and I know on the surface level that looks a little intimidating, looks like it's bad news, but it's in fact a very, very good thing both for the market and both for us as investors. So it's good for the market because we do need to see a rebalancing in the market from time to time. Over the past 16 months, neither the S&P 500 or the NASDAQ has actually hit their one-year average. So the fact that we're seeing that is a very normal and very standard thing to see with the stock market. I would also like to say a 10% decline in the stock market is actually called a correction. So we're actually doing what it should be. It's correcting itself. So we were trading at premium values, we were trading at high prices, and now we're just rebalancing to a more feasible and practical area that the market will begin trading in. So with all that said, I do think that the lows are in. I do think that the fall is over. We may see some turbulence in the market. I don't think we're going to just run and rally right out of this discount, but the lows are in, and now is the time to begin buying some of these stocks. So the reason I love to buy stocks at market lows like this is because it's just discounted. If I was already interested in building my portfolio and investing in the market, now it's just being done at a much cheaper price. So I'm looking at the Mega 7 stocks, I'm looking at index funds, as well as many other blue chips that I love to invest in and have been building a position in over the course of the past 10 years. So very excited to actually see this market decline. Where people are afraid, I am eager because this is the time to make money. These are where the bigger, better, bolder moves are made, and that's what we're doing and looking for while this market is down. So I do want to break down why I think the lows are in. The volatility index did spike in the first week of this panic selling. However, it did not spike in the second week of this panic selling. So Monday the 10th, I did notice that in that trading, we did fall to new lows, fresh lows of this decline. However, the volatility index did not spike any higher. So the volatility index is basically the fear factor of the stock market. It's basically a measurement of the animosity that traders see when buying and selling stocks. So the fact that the market was continuing to do worse, but that fear was not being increased, is telling me that, the dust is starting to settle and now would be the time to begin investing in some of these stocks. So we did see the market rebalance to these averages, but some of the news surrounding the market that kind of triggered this rebalance is the fact that the tariffs had taken place on Tuesday, March 4th. So the tariffs did start, they are engaged. However, they are just negotiation tools. I don't think we're going to have endless tariffs for the next 4 years. I think over the next couple months, we may see a little bit of back and forth between the countries that the tariffs are implemented on. But I do think we'll come to an agreement of some sort, and these trade wars will not even become trade wars. I think that there'll just be a negotiation that eventually gets settled. So initially, that creates some uncertainty for the stock market, started to engage in some of the panic selling, but really that's not going to decimate the stock market. That's not really something that's going to bring us all the way down to zero. So I'm not that worried about it. And then in fact, there's actually more news surrounding the market that gears more towards a positive, trajectory as opposed to a negative. So in February, the Federal Reserve put out their minutes, and those minutes suggested that they are sticking to their plan to not raise rates anymore and to continue lowering rates. We may not see another cut for a few months. I would suggest maybe in the summer we'll see a cut from the Federal Reserve, but their sentiment was committed to continuing to cut rates as opposed to raising them. So positive for the stock market and the economy as a whole, as well as inflation actually cooled for the month of February. So I know at the start of the month, there were a lot of concerns about the price of things. Those prices are showing that they're cooling. I myself even went to Giant, saw some eggs for about 25% less than I was buying them a month ago. So we're beginning to see the trajectory of a cooled down economy, and we're going to, or at least a cooled down inflation in the economy. And I think that's going to incentivize people to go out and purchase and then just stimulate the economy. With all that said, the stock market and the economy are two different beasts. They coexist. However, one is not a reflection of the other. So where the economy could be booming, the stock market could fall. And where the economy could be awful or in a recession, we could see the stock market rally. But right now, we're seeing the market in this decline. It's presenting a wonderful, wonderful buying opportunity, and I myself am taking full advantage of it. So the way I'm taking full advantage of it is I'm starting by buying index funds. I always praise the index funds because they are a blanket investment that covers the entire S&P 500 or the NASDAQ. So by doing so, you're able to invest in the stock market as a whole. You don't have to cherry pick stocks. And then if the market rallies and your few stocks you pick are lagging behind, you won't find yourself jammed up like that investing in an index fund. You'll have a blanket covering the whole market. So the two index funds that I primarily purchase are the UPRO S&P 500 Double Weight ETF and the TQQQ NASDAQ Double Weight ETF. So the reason I buy the double weight ETFs is because you're getting the same investment strategy, although you're getting a double premium on the moves that it'll make. So simply said, if the stock market appreciates 10%, that double weight ETF should appreciate 20%. It's not always going to be to the penny because these ETFs trade based on the values of options contracts and things of that nature. But relatively, you will be traveling at a double pace of what the market is doing. Keep in mind, on the contrary, if the market were to fall 10%, that ETF would fall to 20%. However, when the market is broadly down like this and we see a general decline across all stocks, I love to invest in the index funds because it's basically the foundation of my portfolio. I invest in many, many, many different companies, but that's kind of like the concrete under the house. It builds foundation, so when particular stocks aren't performing the way we would expect, those ETFs hold the ground on our portfolio. Some of the more particular stocks I'm buying during this decline are the Mega 7. So the Mega 7 include Apple, Alphabet, Amazon, Meta, Microsoft, Nvidia, and Tesla. All 7 of which totally shape the world that we live in, and they're all presented at absolutely phenomenal discounts right now. They're all trading roughly at their 1-year average. So I always like to preach, I love investing and trading stocks when they're at their 1-year average. It's just always makes sense to me. In the 11 years that I've been investing and trading, the 1-year average is a metric that all stocks always seem to eventually trade to. So when I see them at the 1-year average, that just screams buy to me. So I've been buying basically all 7 of those. Some of the other blue chip stocks that I've been investing in during this decline are Boeing, Home Depot, Morgan Stanley. We have McDonald's, we have Caterpillar, we have Disney, and some Coca-Cola. So all phenomenal stocks. I'm sure you've heard of basically every single one, and they are just companies that shape the way we live in the world today, and they will just continue to innovate and create the infrastructure of society, essentially. Not to mention, most of those stocks do pay a dividend. So what a dividend is it's an income that you get just for ownership of the shares. Every 3 months, every quarter, these companies pay you for ownership of those shares. So it creates a silent background income that you get just for investing your money. So I've always been a huge believer in that. When markets are at a discount like this, the rate that you're getting the dividends at is increased because it's a lower upfront purchase for the same rate, essentially. So all good reasons to be investing in the stock market at this time. I love to answer any questions that anybody ever may have. If you have trouble understanding the market, or if you want maybe just a clearer insight on something I'm discussing in an episode, please shoot me a message. I would always be happy to answer any questions you may have. So with that, please follow me on Facebook and Instagram. I like to keep daily updates of what's going on in the market. And with that, I'm happy to help you on your financial journey. Thank you for tuning in.